What if being 15 years old was actually a financial superpower? Not because you have money, not because you're experienced, but because you have something almost no adult can buy back: time. Today, we're going to find out what happens if a 15-year-old invests money and doesn't touch it until age 60. The results are honestly insane. Let's start with something simple: the S&P 500. The S&P 500 is an index that tracks 500 of the largest companies in the United States. Companies like Apple, Microsoft, Amazon, Google, and many more. Instead of betting on one company, you're investing in all of them at once. Historically, the S&P 500 has returned about 10% per year on average before inflation, and about 7 to 8% after inflation over long periods of time. Not every year. Some years it drops 20%. Some years it goes up 30%. But over decades, it has averaged around 8% after inflation. And decades are what matter here. Now let's run the numbers. Imagine a 15-year-old invests $10,000 today, and then does absolutely nothing. No extra contributions. Just leaves it invested until age 60. That's 45 years. At an average return of 8% per year, that $10,000 turns into roughly $320,000 from just leaving it alone. No extra work. That's compound interest. But now let's make it realistic. Let's say at age 22, that same person starts investing $400 per month. That's $4,800 per year. They keep investing every single month until age 60. No stock picking. Just a simple S&P 500 index fund earning 8% annually. By age 60, they don't end up with a few $100,000. They end up with around $1.6 to $1.8 million. And most of that growth happens in the later years. That's the crazy part. Here's how compound interest really works. In the early years, growth feels slow. Year 1, small increase. Year 2, slightly bigger. But by year 30 or 40, the curve goes almost vertical. You're earning money on your original investment, on decades of growth, and on decades of previous interest. It's like a snowball rolling downhill. Slow at first, then unstoppable. Now here's something even more interesting. Let's compare two people. Person A starts investing at 15. Person B waits until 25. Just a 10-year delay. Everything else is identical. Same investments, same returns, same retirement age. That 10-year delay can cost over $1 million by age 60. Not because person B made bad investments, but because they lost time. And in investing, time is everything. But let's talk about risk. The stock market is not guaranteed. There are crashes, recessions, bear markets. Some years you might lose 20 or 30%. That's normal. But historically, over long periods of 30, 40, or 50 years, the market has recovered and continued growing. That's why index funds are powerful. Instead of trying to guess which company will win, you own the entire market. If one company fails, it barely affects you. You're betting on the overall growth of the economy. Now what about individual stocks? Yes, picking the right stock can make you rich faster. If you had invested in Apple or Amazon early on, you could have made life-changing money. But for every winner, there are dozens of companies that failed. Individual stocks are higher risk and higher potential reward. Index funds are lower risk and historically reliable over long periods. In fact, most professional investors fail to consistently beat the S&P 500 over time. So if experts struggle to outperform the market, maybe the smarter move is consistency. If you want to test this yourself, use a compound interest calculator. Go to investor.gov and use their compound interest calculator, or search for NerdWallet's investment calculator. Enter. Starting amount, $10,000. Monthly contribution, $400. Years invested, 45. Expected return, try 7%, 8%, and 10%. And watch what happens. The growth in the final 10 to 15 years is massive. It doesn't feel real, but that's math. Here's the truth. Investing at 15 isn't flashy. It's not exciting. It's slow. Your friends might spend money on short-term stuff. But investing early is different. It's quiet. It's patient. It's long-term. And that's exactly why it works. Because most people don't start early. Most people wait. And waiting is expensive. Imagine turning 60 and realizing that your 15-year-old self made one smart decision. Just one. You didn't gamble. You didn't chase trends. You didn't try to get rich overnight. You just started early and stayed consistent. That's the real superpower. Not intelligence, not luck, time. So the real question isn't, can a 15-year-old invest? It's, can a 15-year-old think long-term? Because if history continues, that decision could be worth millions.